Owen is now going to tell us about how to create impact and value in real estate in a megatrend perspective. The stage is yours again.
For the next part, I'm going to talk a little bit about trends that we see in the commercial real estate sector, and some of these are linked to megatrends as well. So working with innovation, these are really the things that we have to take a look at. We're going to take a macro perspective down to a micro perspective in these as well, too. And I'm going to highlight 5 areas that we're looking at right now that are going to start impacting our decision making, and some of the things that we've observed working with some of the companies in different countries. So part 1 is the great Dickens novel, It's a Tale of Two Cities. And so the first thing is that it talks a lot about, the first is that the population shift is really changing. So we've heard a lot that maybe that we're going to be migrating towards cities, and we've been watching that trend a lot, specifically with millennials. It seems that as millennials are enjoying living in the cities right now, what will happen when they start having kids, and will they look for the same things like safer neighborhoods, better schools, less congestion, and will they start migrating out to the cities? Well, we're starting to have enough robust data come in that in fact that's not the case. They're electing to stay within the cities and raise families in cities. The migration shift to the cities is much more an Eastern thing that we're seeing right now in countries more along the lines of Asia and India. 35% of the urban shift are going to come from areas of India, China, and Nigeria, with Lagos right now being the largest growing city in the world. And the UN is expecting that by 2030, we will have a total of 43 megacities with inhabitants of 10 million people or more. So we see that cities are really kind of the area where we're concentrating our development and our activities. And what does this actually mean for us? Well, in terms of our sustainable impact on this planet, you can actually track, and I suggest taking a look at some research by a guy named John Fuentes from MIT University, where you can actually track carbon performance and output from cities with how affluent or wealthy that city's population is. And it holds true across the board. One of the great models of how somebody can actually have a positive impact is on that ratio is Lisbon, and what Lisbon is doing there. The second is that the emerging economies are not emerging anymore. So we're expected to see that the E7 or the emerging 7 countries will overtake the established G7 by 2030. And what we can then see from in terms of a global scale is that it's going to shift a lot of capital resources and resource allocation from west to east. And why do I talk at it from this perspective? Is because right now, capital markets are really defining development activity. And the capital markets are not necessarily your local bank anymore. These are large financial institutions coming from London, coming from Paris, coming from New York City, coming from Hong Kong, and or Tokyo, and they are injecting massive amounts of cash into the real estate market. And so watching, this is what they're looking at. They're not necessarily attached to your neighborhood or your country anymore. They're looking at how do they opportunistically play the markets. So, and it's not going to just surpass them. By 2050, we're looking at the E7 is going to more than double the GDP output of the E7 by 2050. So what we're seeing now is also not just a expansion of the East and also Brazil, of course, but we're seeing a compounding effect on what the effects of these cities is going to have. So if we come a little bit closer to home and in the European continent, it's clear today more than ever that Europe is not a single market, and especially not in terms of real estate. It is a very fractured market where we're still seeing that micro, I don't want to call them crisis, but we're having micro shifts in markets taking place in different areas. And this is data coming in from the 2017. Again, market data getting published by the service agencies is always a few months behind, but this is the most up-to-date. What we have is what you see is even areas like Berlin versus Milan are having different actions in itself. And these are the type of charts and things that those institutional brokers are looking for. And not to mention that those brokers are getting bigger. So where a lot of the money that they're looking for is coming from the large pension funds that are looking to spread risks between investments in stocks and bonds, a little bit more risky. They look to hedge that risk in the real estate markets. So, and then we're taking a look now at what are macroeconomic influences on those real estate returns, as well as localized risk. So what you call diversified beta and global beta. The census that's coming out of a lot of those companies right now is that you can pretty much make a safe bet in what they're calling the dynamic 40. And these are countries and cities within those countries where you can really relatively have a safe bet. And you're even seeing the shift now come to more of the top 10. So when we're talking with our institutional investors who are buying a number of our buildings, the name of the game today is called obsolescence risk. And they want to reduce what they call obsolescence risk, which means that the success of the project is not on the day you deliver it. It's 10, 15, 30 years after that project. Is it still viable within the market? And that's where this flexibility comes in. A key driver of that market flexibility, of the market viability, is also what's going on in those countries. So what's really interesting to see is, well, how the heck does Cambridge get on here? You would expect that these would be those major, safe megacities that you would see. Why is Cambridge, and why is Cambridge not only ranked number 2, but why did it only jump up from 3 to 2? Well, we'll go into that a little bit later. These are the charts that you're looking at in terms of your returns, and basically what you see is the difference between the rise and the run of your other cities versus your top 40 is relatively small. But taking a look at making the investments, that's the bottom, the gray that starts at the highest, but then the rise and the run is the lowest, meaning that you're going to have the least return. The top 10 cities can be the most risky. They're obviously the most volatile, which means that you'll have the best chance for profit gains, and that's really where the institutional investors are making their play. It's about timing the cycles the best that they can, and how do they get in low, do value-added stock, and then get out at about 10 o'clock. Right now, what we're seeing is that, at least from our buyers, is that central business district with about a 10, 15, 20-year lease agreement is still okay to do, but institutional investors are already starting to pull away from tier 2 cities or secondary cities. We're looking at rising interest rates right now, and we're expecting that we'll actually have another shock to our real estate system coming in and around between 2020 and 2021. So in the year 2020 or Q1 2021. That's what our models are showing right now. So expect another wild roller coaster to come up relatively sooner. Housing markets are a little bit different than commercial. So in Europe, we're seeing a little bit more of a population swell. So we're, especially in key markets like Amsterdam, perhaps here as well, like Berlin, the housing dynamics are changing, and there's still a scarcity of housing. So those are products that might lag behind the commercial space. Number 2, it's all about tech. And why I say this is, I want to show you this. This is alarming. Look how quickly things have changed in the last 10 years. Look at the top 10 largest companies in 2008. These are the standard blue chip companies that we always associated with big business. They are petrochemical companies, they're fossil fuel companies, they're energy providers, they're big conglomerates. And the only one that is still on that list today is Microsoft. In fact, Berkshire Hathaway is actually an outlier. If you go past Berkshire Hathaway, then you start to see a little bit of the banks, but even tech dominates the top 17 companies on that list. The reaction of these tech companies really blowing up and actually influencing the way that we work, live, and play, and how we access information and are able to use information is mean that our worlds really are changing at a much more rapid pace. I think we see that showing up in how we behave as countries, our political decisions, so on and so forth, but that uncertainty from the speed, basically tech has always worked on Moore's law and the doubling of the microprocessors every 2 years. We're starting to see those impacts trickling down into the rest of our society. At the same time, the access to more data and less information of the data makes our world extremely complex. So when you start coupling speed and complexity, the data companies and the high-tech companies are thriving in this space, but the rest of the companies, primarily manufacturing, is lagging and a bit slow to catch up. Does anybody know what this image is? Scream it out if you know. This is the mapping of the internet in the world. So this is really how our world's digital infrastructure works in mapping. And I wonder where in those pops is Silicon Valley. But I think that's a great illumination of the complexity of our world. And oftentimes it feels like that. So these companies are getting mega wealthy. They're turning over billions per quarter. They're really the new juggernauts of our world. And what you're seeing in the real estate is that many of them are starting to now behave like private developers, where for a long time the objective was to rent buildings and lease the space. And when they're growing and adding thousands of jobs per month, then that made that flexibility of the space, and they were always growing out of their jacket. The typical thing was that the speed was so big, and actually you have almost this cash trap where you make so much money that you're not necessarily really checking your costs anymore. Is that a typical model would be that a large tech firm would enter into a space in Silicon Valley, and I'll never forget the first time I went there, I was expecting like something out of Blade Runner, where it was this high-tech community and all this cool stuff was going on. But no, it's actually just like an office park, a suburban office park in the United States built in the 80s and 90s. It's actually quite unattractive. But they would lease this space, they would inject millions into transforming it to make it more tech and cool and all of that. And then they would have to inject the same millions to return the building back to its original state. And they've realized at the same time they're not able to take advantage of one of the largest sources of value they have, which is their brand value of being able to attract other companies around them. And they're also situated primarily around universities. That's Cambridge, that's Oxford. So now what you're starting to see is companies, for example, like Google. This is the new Shorebird campus, which was released in Q4 of 2018, so that's a new development. Google has now spent $2.3 billion buying land and its buildings that they consider strategically significant. They're investing billions in building out San Jose and the Silicon Valley area. And not only are they building campuses that are for their companies, but these are completely mixed-use communities. As you'll see, this doesn't look like a typical tech office park. This is now what Google will completely build in Shorebird, and it's going to be a mix of hotels, shopping, facilities, restaurants, of course the Google restaurants, but other restaurants. And on Shorebird, they're going to build in 2,000 new homes, 20% of which will be considered affordable housing. So they're going to invite outside into the community. So they're really looking to build immersive communities. This is the objective of the tech industry right now. And while we may think that, you see Google executives, you can find them in interviews saying that we feel we are paying our coding and engineering people through the teeth, yet they continue to come back to us and say, we can't afford to buy a home in the local area. So the housing prices are really shifting these decision-making processes as well. Google's not alone. This is Facebook's new Menlo Park campus. This is what Facebook's campus will look like. Again, doesn't necessarily look like an office park. They're really building whole subdivisions and communities. They're starting divisions within their companies for development agencies, and they've been taking great developers and bringing them in-house right now. So what you have is you have a huge access to perpetual cash flows, and at the same time, you now have the talent in-house, and you have the money to take the land positions. So you really start seeing these tech giants start operating in building out their own communities. In fact, remember this sheet? These are the companies that are building campuses right now. So at the same time, what does this mean for us over here? Because Silicon Valley still does feel quite far away. Well, you see that now political decisions in the United States are restricting access to visas for engineers, meaning that these tech companies are shifting out and overseas now as they're looking to expand their services to become much more global. Google's second largest campus that they're building is actually in India, but you start to see that Europe is emerging as a major tech hub, primarily in the areas of AI, and that's where we see Cambridge popping up. Cambridge is one of the great AI hubs right now around the world, and so we're starting to see really these are driving it. Number 3, the largest area that we've seen is in the customer and what the tenants are looking for. And so as a developer, as an institutional investor, you're not necessarily just looking at cash flows, you need to be human focused at this time right now, because your customer is actually your client. And how we see this shifting right now is that typically commercial real estate functions within large organizations were housed under the finance department. The CFO was the head there, and the CFO was really about cost control on their real estate portfolio. You saw this impact a lot of decisions. Remember New America? Did you guys have the new way of work where we actually started saying, yeah, you know, stimulating communication with these large open plan offices, and this is going to be great for the companies. The reality of the situation is that we had too many offices open up in different areas, and we wanted to close them down, lay people off, and we could actually pack people into smaller pieces. That was primarily a financial driver. But the world today is not only about financial drivers, and this has really done a great job from Cushman & Wakefield, has really been working very hard on this topic right now. I would recommend looking at a lot of what Cushman is talking about. They have a very intelligent and smart application of this, as does CBRE and Jones Lang LaSalle. All three of those start taking a look. This is really a topic that all of these companies are looking at right now. The key today is talent. How do I attract and retain the most talented and motivated staff? Because talent is your largest commodity, and the companies really understand that. So that's why it's shifting from the CFO side over to the CEO side. And it's not overwhelming, but we're starting to see that it's trending a lot more. Because again, being able to attract the talent is not just about how do we compete for a broad set of skills. Those skills are also becoming much smaller. So what you're seeing is that banks are transforming into tech companies. All of our banking is now happening in digital. You're seeing governments need much more tech. So everybody is competing for those tech jobs today. And we're going to see that the next blue-collar job of our next 100 years is going to be coding, or at least the 50 years. This is the next blue-collar job. So this is where we need to be investing in our resources in education from very early all the way through high school, because manufacturing can all be done by robotics. And so this is from the World Green Building Council. Perhaps many of you have seen this, and it illuminates and outlines the situation very clearly, is that the real estate cost for a company on average is roughly 9% of its cost on an annual basis. Interestingly enough, energy is only 1%. So all of the people out there trying to attract great companies by saying, yeah, we can reduce your energy bill, well, I've got news for you. They really don't care. It's less than 1%. The largest cost is 90% is on their payroll. So this is why your client is your customer, because if you can actually now have value propositions that show that we are actually helping you to attract talent and keep them in-house and keep them engaged, if you look at the statistics of how many people are actually disengaged at work and costing their companies money, it's alarming. This was a study that we did for the World Green Building Council. We were invited by them to do 2 buildings. This was the Hirama building, and what we, again, were financially driven, and we like to show that value proposition, is what we did was we worked together with KPMG and an institution called Leesman Index, which is the largest global survey of workplace effectiveness. And we started showing how our buildings, we would measure them on the Leesman Index before. We would then make calculated interventions into the buildings based on what was going well and what was not going well to engage their workforce and help them to attract talent, be productive and effective. And then we delivered all those things into the new building, and you see up at the top corner here the gains that we actually had. One interesting one is actually we went down in noise. So we don't want to just show all the things that we did great. We want to actually show all these other ones. We then contracted in KPMG with their true cost calculation. The productivity gains of occupying this building versus the other building was a net present value of 42 million euros to the company occupying that building, which is roughly half their year. It was half their rent over a 20-year period. It was an 80 million euro lease agreement over 20 years. One of the really interesting projects to keep an eye on right now is 22 Bishopsgate, and this is also, again, one of the head of Cushman & Wakefield's customer customer services division is working here as well, and she's worked with Sir Stuart Lipton on all of his projects. It's a fantastic project, but you can also read about this in Leesman Studies and a number of other areas. And what makes this project so very cool is it's one of the areas where it's the largest amount of offering for non-typical workspace. It's in the UK, so about 100,000 square feet is dedicated to non-traditional work settings. And there are also areas where the community and the public can come into this building and start taking advantage of that as well, because lobby working in the communities is really a very exciting value proposition. But the most exciting thing is right now the world of work is about creating really immersive experience. And you see that in retail taking place, but in offices it's nonetheless. This is the top floor of Bishopsgate. They're going to have a climbing wall on the windows so that you can actually go climbing on your spare time in Bishopsgate. These types of things are valuable in helping people say, wow, I'd really like to work there. The second is, again, that you see that these immersive experiences and the tech companies, it's starting to all come together. You see that urban tech hubs are the hottest product on the market. If you've got urban tech hubs, then you've got institutional investors behind you saying, I want that, I want that. You can command your exit yield at a much more attractive rate, and it's a very, very safe product. It's interesting to see how this is really shaping up, is that you see that, oops, it's cutting off the screen a little bit, but what you see is that in EMEA, it's really starting to kind of go up by about 40% here. So, and the one thing that you start to see in any of these types of situations, the picture behind that is, of course, WeWork. And WeWork has been this kind of new phenomenon that's jumped onto the market, starting in the USA, and now it's expanding into Europe. They are getting much, much better in Europe, so they're really coming through. But this is causing a lot of companies to really re-engage on how they traditionally look for contracts. Institutional investors and building owners are having a much more challenging time obtaining long-term contracts, fixed rent periods. That traditional price per square meter is kind of under pressure right now. And so stacking those contracts and the spaces with flexibility and the incentives while doing things like centralizing all of your hospitality and common spaces is a way that you can also engage commitment from these companies. Number 4 is called Believe the Hype. And we've heard a lot about it, but AI and the digital transformation is really impacting how we as people are engaging with our physical environment, and that will continue to increase. So big data is making us much more effective within our allocation of space. From an investor standpoint, they're really talking about leakage out of the property that they have. So leakage occurs when you have high operating costs for an area. These are things like cooling, heating, electricity costs. These are all the leakages that the owner is paying in a typical lease agreement. So big data is investing from an investor side is a discussion about reducing the leakage out of the cash flow. But from the occupant side, it's really all about how do we, again, maximize the effectiveness of our workforce. With that being said, transparency is going to be the big issue of the day. And you see that things that have taken place within the last 2-3 years where we really start to see how much we are exposed with our data being out there is making a lot of people uncomfortable, and all of our tenants are coming to us making sure that they want to have secured data lines, and that even in our multi-tenant development projects, that people cannot see who's entering buildings. So we have to codify people in terms of numbers that do not link to who they are. But it's a very tricky situation right now, so we have to be conscious, and I would propose that we crawl before we run here. So be careful. You don't want to find yourself in a sticky situation. But big data, tech, and machinery, and AI is not just affecting the occupation of the space. It's probably most in the coming years, and the trends that we'll see is going to affect the construction community, because that is an area right now that is ripe for change, and till right now has not done really enough to actually reinvent itself. It's very still traditional in how it goes. And you see things like being able to reduce the construction time on site. Time is money, time is risk. And being able to reduce failure costs. A typical general contractor will work on a 2, 3, 4% profit margin, but if things go wrong, they're on the hook for failure costs of upwards to 15, 16%. And this is an area where machinery can help reduce those error, the human error and the failure costs as well. One of the areas, and by the way, in demolition, this is extremely exciting because the cost, if we wanted to deconstruct our buildings right now, the labor cost is the highest cost in the building. And we've learned things like make your doorways already wider. So our doorways are wider than the current code is calling for because we're already planning to get machines through the doors so that it can clip the buildings apart instead of getting people through there that have to actually manually take buildings apart. And these things are saving factors of 10, 15% on the deconstruction costs of the buildings. But blockchain is one that we talk a lot about, and it's now only starting to get its ripe discussion in the construction world. And the primary discussion going around blockchain right now is in terms of contracts and wallets and being able to control your cash flow much better so that we don't simply say, here's phase one, all the money for the facade, but that we can actually hold the money in escrow in a digital wallet. And when we actually have actions being taken place, like the on-site inspector signing off that indeed the windows are in place and they're up to code and up to spec, only then will that small piece of money be released for those windows. So we're only paying for actually success of the projects. And you see that coming through not just on the inside and the tenants, but also in the contractors get ready for success and performance-based fees. I would say in terms of one of the final areas that we're really hearing a lot about is office and commercial real estate. Take a look to your cousin. The hospitality industry has blown past you in terms of the offerings for amenities. And right now what you're seeing is that people are really steering the assortment and the choice of what they want from their app, whether commercial owners like it or not. Because I had to work last night on this presentation. I'm always tweaking it right to the end. But I got right in and hopped on the app of Foodora and ordered some nice tacos to my hotel room. And that's available everywhere now. So if you have terrible food or you don't have an assortment in your office, customers will start getting on their own apps and taking care of this. So what you need to see is that if you really want to continue to earn on your amenities in commercial real estate, it has to be a push-pull where you have to be listening to your customer and very close to your customer to see what they want and be able to adjust your assortment as it needs, perhaps even seasonally. The last and the fifth is indeed the case. It's go green or go home. And you see that in Norway, for example, 90% of the new stock coming on the market is BREEAM certified, meaning that that is the norm. It is not anymore a differentiator. It is not an area where it is, can I get a cool factor or a wow factor? It is something that if you do not have that, your product is trading at a discount. And I would see from a macro perspective, I invite you all to become familiar with a company that I'm going to talk about next. And what they're really working on is global disasters. The truth is that climate change, the data is in. The facts are irrefutable. So it is something that is drastically impacting our communities. And this is the company that I'm talking about. They moved into Park 2020. This was the only company that actually chose for Park 2020 because of its green strategy. And when I got to sit down and they said, oh, you got to meet these people. They're extremely innovative in how they think. It's Swiss Re. So if taking a look at like insurance, I don't know about all of you, but my discussions with my insurance companies are not the most engaging and exciting. It's all about trying to get the money from them if something bad happens, and they never want to pay. And so insurance I never thought that as an innovative area. Swiss Re is a reinsurance, so they are insuring insurance companies, and they are insuring large organizations and areas. They insure, for example, California against all its wildfires. They are insuring the United States against its natural disasters. They're also insuring the agriculture of California. So when you start taking a look at this, it's extremely exciting. Since 1969 already, Swiss Re has published every single year something called Sigma. And go check it out. It is the actual damages that the insurance company is taking for natural and man-made disasters. And this is a fascinating way to start taking a look at what the real impacts and the monetary costs on our global gross domestic product is in terms of these natural disasters. And what you start to see is that there are catastrophic losses coming up, and they are actually intensifying. So looking at these insurance claims is a very great way to start saying, okay, is the frequency of these disasters occurring like science was expecting, and are they intensifying? Well, looking at this, the answer is yes. In 2017, the global reinsurance industry shelled out $337 billion in insurance in losses. That is about 2 times greater than 2016's total, which was $180 billion, and the 10-year average for these claims is about $190 billion. That represented 44% of our global gross domestic product, where the 10-year average is roughly 25%. So these are shocking numbers, and these are really the costs to that. So what is Swiss Re doing? And this is one of the topics that we had at a conversation at our table. I believe much more that our world is starting to shift, not quick enough, but we are shifting from reactive to proactive. And it's in the best interest for us to do so. Swiss Re right now is investing massive amounts of money into protecting and regrowing coral reef in the Gulf of Mexico. Not because they love Finding Nemo like I do, but because the coral reef is actually the largest buffer and barrier against large surges of water from hurricanes. And they are insuring all of the coastal property around Texas and Florida. At the same time, this was a great one. We had we've introduced beehives at Park 2020, and we wanted to get the story out about colony collapse disorder for the honeybee, and actually how serious this is for our world. If the honeybee goes, then yeah, we're in a bad place. And so we were talking with Swiss Re about this, and they really took to it. Swiss Re is now investing millions of euros lobbying Brussels to get the honeybee and colony collapse disorder as a topic on the agenda of the EU. And why are they doing that? Is it because they love the honeybee? No, it's because actually they're insuring over $2 billion worth of agriculture in California, of which the honeybee is pollinating things like almonds, a massive export of California. They're pollinating all the wheat, all the feedstock for the meat industry. So you start to see that Swiss Re is taking proactive positions to shore up its long-term insurance claims. You also start to see that industry is really addressing climate change as well. The pervasiveness of PV and electric vehicles in this country, I don't have to tell you much about it. You guys are number one. China is massively expanding its EV assortment. Holland's doing great too. But we're still seeing that it's not taking up as quickly as we need it to, but it is getting much better. And clean renewable energy is where we need to go. There's plenty of articles coming out right now, and I believe there's also going to be a comedy television show about your Norwegian investment funds. Have you heard about this one? So the oil that Norway has been really earning lots of money off of is going out into the market. They're one of the largest institutional investors in the entire world. And now they're saying that they're not going to invest in coal anymore. And yeah, oil coming down from 100 to 60 some odd dollars a barrel is also putting a lot of pressure on that. So strategic investments in clean renewable energy. I would also propose that burning trash is not a viable solution. That's what the Netherlands did, and take our word for it. We have investing in these incineration plants that are putting off huge toxins. We're also going to have to bear the brunt to dismantle those, because we're going to need to go more along to clean renewables. And for also the spider chart that we also showed from resource depletion and resource scarcity is causing a lot of geopolitical risk, and it's also causing construction prices to go really through the roof, and the price volatility of these raw inputs are also affecting that as well. This is a translation from the University of Delft of a professor named Peter Lescure, and these are all of our the anticipated years we have left of all of our metals. Inside the red box is under 20 years left. So you start to see things coming up, like the topic of urban mining is becoming much more of a hot topic right now, and it's actually a viable topic because Europe does not have access to mining operations like they do in other developing countries right now. So our access to these raw materials is greatly limited on a geopolitical scale, which means that we need to start finding intelligent ways to get the resources we need onto the other areas. I don't know if any of you saw it a few years ago. It was probably about 6 or 7 years ago. There was an under-the-radar transaction that was really a very important one, which was that the Hong Kong Stock Exchange bought the London Metals Exchange. So they bought the London Metals Exchange, which is the only real channel to start trading these resources. And why did they do that? Well, they did it. They bought it, excuse me, for 126 times turnover. So why would you buy something that you couldn't recoup that investment in 126 years unless they're taking a long-term strategic play because they control mining, they control consumption, and now they control distribution of the raw materials. And what happens when they have those disputes over the South China Seas now? It's whoops, our delivery of all your rare earth metals is somehow, it's been slowed down a little bit, and you see the Japanese electronics markets really taking a hit. So you start to see geopolitical actions taking place already based on resource scarcity. Another interesting one to keep an eye on is phosphate. Right now, roughly 70 to 80% of our world's phosphate is controlled by Morocco. And Holland, for example, in phosphate, we are a big agriculture community. So access to phosphate is very important to us, and you're starting to see political decisions being made that Holland wants to be completely phosphate independent. It's not only a geopolitical issue, it's also a boardroom issue. So this is also another interesting survey to start following. It's the Accenture Strategy Survey, where they are talking to the boardrooms of major corporations every single year. And since 2016, you see that 80% of CEOs are already saying that demonstrating purpose-driven commitment to sustainability is a differentiator in their community, in their industry. 97% feel that it is strategically significant to the future of the business. However, only 67% say they have a grasp on what that means. So you start to see that there's awareness and recognition from the corporations, but how they're addressing it is still something that's being determined. And why is that? Because what you're seeing is that what are typically considered externalities from the companies are now being shifted inside on the balance sheet. Things like in 2023, in my country, the Netherlands, you are all buildings, commercial real estate with an energy label of D or lower, no longer classified as commercial real estate. You need to vacate the premises on January 1st, 2023. So you start to see that politics is really pushing those issues. This is a good kind of non-real estate example, but it's one that I think it proves a good point over toxicity, is the circular economy is a topic right now of discussion, and while it's much more familiar in Europe, it's increasing in discussion in APAC and North America as well. But the question we really need to be asking is not can we go circular, but how do we go circular? Not can we do something, but should we do something? So someone came up with the brilliant model that I've got all of these old tires that are sitting in landfills. Someone will pay me to take them away. Then I can cut them up and I can sell that back to the soccer pitches or the football pitches as those rubber pellets that are in the football pitches. But now the science is starting to come in that actually what you find in these tires are actually arsenic, poison. Is that what we want inside the cuts of our kids as they scrape their knees? We're finding things like lead and mercury. We've gone backwards. We've already removed lead out of the paint generations ago, but now we've got it in the football pitches. So no one's really asking what are the unintended consequences. And what you start to see here are things like industry privatizing profit and socializing risk. And these are issues that really need to change and need to be addressed within the circular economy. The interior health, well-being, and productivity is already also starting to be proven, that you can start to see that cognitive function is improved by air quality. This is a study done by Harvard and Syracuse University. Joe Allen is a fantastic researcher who's working on this right now. And things like using information, strategy, critical or crisis response, not unimportant things in a corporate situation are all increased by huge amounts by the reduction of both CO2 and VOCs, or volatile organic compounds, within the airflow. And the last but not least, I believe it's last, is the discussion about reporting and documentation and all of that. I'm a big fan, actually, of what Google's doing in terms of Portico. And it's really cool. They're right on the cusp right now of launching this as a public tool that anybody can use worldwide. Right now, they're still in an early phases, so they have a limited number of test participants working with them right now to see exactly how effective this is so that they can continue to improve. And what they're looking is really what is called a tiered approach. And I like this a lot. And it basically comes to screen, assess, optimize. And so we don't have enough of these fully optimized, healthy materials ready for market right now. But what we can actually start doing is start tiering what is the quality of the material availability out there. And so product declarations are a great way inside the door, and they're fantastic. Where they're third-party certified, verified, like we heard today, then you even move up into the assess area, because anybody can say that my product's healthy, this is what's in it. They can also leave out anything that they don't want to declare. However, when it becomes third-party, independently verified, then we have much more comfort in what they say. The last part is that, okay, you've declared that there's arsenic, mercury, lead inside your tires. What are you going to do about it? Because that's the ultimate objective, where we start phasing out these hazardous chemicals and replacing the composition of the product from a chemical standpoint to only things that are defined positive. And I get that the world wants to talk about a conversation of less bad, let's reduce our negative impact. But I pose to you a question. I recently got married last year on March 24th. It's been a fantastic year. My wife and I, thank you. My wife and I are starting to have talks about kids right now. And that, of course, has, what kind of father do you want to be? Many of you out here have already taken that plunge, so I look to hear your advice. I'm well open to it. But I pose to you a question. If I hit my kid 2 days a week instead of 5 days a week, does that make me a good dad? No, it makes me a monster. So being less bad is still, per definition, bad. You are still bad, per definition, only less so. So this is where it comes back into the earlier topic of today, to define your values and your principles as organizations and understand what good is and what fantastic is, and start building your products on that. Companies like Method Soap, for example, People Against Dirty. And that is end of slideshow, click to exit. Thank you very much.
This is really interesting, mind-blowing.
Thank you. I find it interesting too. It piques curiosity in any respect. And
Yes,
I
yes.
invite, please, the one thing I would say is don't take my word for it. Fact check and go check all the information. You'll get these things and discover that data for yourself and expand upon that and take that home and take that to your offices.
Yeah, I think you created some curiosity in all of us now.
Good, that's the objective.